Good morning everyone. My name is John LV Aiko, reporter from Group 2. Accounting events and transaction defined. So my topic is all about the elements of financial statements. So there are 5 elements of financial statement. So these are assets, liabilities, equity, income or revenue, and expenses. Assets. An asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow. For example, goodwill, patents, account receivable, inventory, land, cash in bank, cash in hand, prepaid expenses, and such other items that meet the definition of assets. So when we say assets, guys, is the resource owned by the entity. So meaning, mo ni siya ang mga pag-aari bitaw sa ka negosyo nga valuable. Mo ni siya yung mga pag-aari sa ka business. Liabilities. These are the legal obligation of entity for paying to another organization or individual. The settlement of liabilities result decrease in its financial resources. So when we say liabilities, mo na siya ang giingon nato nga utang sa usa ka business or negosyo. Utang siya sa business entity. Okay. Liabilities are of 2 types. So, ang liabilities na siya 2 types. Muna siya ang current liabilities and non-current liabilities. So, when we say current liabilities, these are the obligations that are expected to get settled within 12 months of their creation date. So, current liabilities, muna siya amount due to paid to creditors within 12 months. Non-current liabilities. These are the obligations that get settled in more than 12 months from the date for their creation. For example, bank loan, overdraft, tax payable, interest payable, and etc. So, kini non-current liabilities also known as long-term na siya. Long-term liabilities are obligation listed on the balance sheet not due for more than a year. Equity. Equity is the residual interest in the assets of entity after deducting all its liabilities. In simple words, equity is the excess of aggregate assets over aggregate liabilities for a financial year. Hence, an increase or decrease in equity is dependent upon the movement of assets and liabilities of the organization in the financial year. So when we say equity, assets minus liabilities, din ang mahabilin, mao na siya ang gitawag nato nga owner's equity. Items that form a part of equity are share capital, return earnings and loss, revaluation gain and loss. Income or revenue. So kining income, mao ni siya ang kita na to sa atong hinaguan sa business. Muna siya ang atong mga kita na to. Accounting principle used for recording income. Cash basis. The income is recognized and recorded when it is actually received in cash by the entity. So when we say so meaning the business would record revenues from sales when the payment actually arrives 30 days or so after the invoice is sent. Accrual basis. The income is recognized and recorded when it's become accrued to the organization and may be actually received by the entity at a later date of time. Example of income: sales, income generated from service rendered, and interest from bank, deposit, dividend received from investment. In accrual basis, you would record revenue when a project complete rather than when you get paid. Expenses. Expenses are recorded in profit and loss account in accordance with the revenue generated, and expenses will automatically be created in the profit and loss account when an asset value becomes nil and no future economic benefits are expected from it. So kini expenses mo sad ni siya ang mga nagastos sa pagpadagan sa atoang business. Mo siya ang mga atong mga nagasto. That's all.
Good morning, everyone. So our topic is all about accounting equations. So what is the accounting equations? Accounting equations is the finances of every business consists of two basic elements, what it owns and what it owes. Assets are the overall resources a business owns. The owner's equity is the share the owner has on these assets, such as personal investments or drawings. Liabilities, on the other hand, show how much money is owed. The relationship between these three financial components is expressed through the accounting equations as shown below. As we previously mentioned, the accounting equation is the same for all businesses. It's extremely important for businesses in that it provides the basis for calculating various financial ratios as well as for creating financial statements. Before getting into how the accounting equation helps balance double entry bookkeeping, let's explain each element of the equation in detail. So first, what are the three elements in the accounting equation formula? So the first is assets. Assets represent the ability your business has to provide goods and services. Or in other words, it includes all things of value that are used to perform activities such as production and sales. We divide assets into two main categories, short-term and long-term. The short-term assets are expected to be consumed within a year. They include cash and cash equivalents, inventory, accounts receivable, prepared expenses. Long-term assets extend their use over the 1 year period. They can be either tangible, physical, or intangible. Tangible assets are buildings, land, and equipment. Intangible ones consist of patents, trademarks, or copyrights. Next element is the liabilities. Liabilities or obligations are assets owed to creditors. Creditors include people or entities the business owes money to, such as employees, government agencies, banks, and more. We classify liabilities the same way we do assets based on current or long-term periods of time. Current or short-term liabilities are employee payroll, invoices, utility, and supply expenses. Long-term liabilities cover loans, mortgages, and deferred taxes. Next is the owner's equity. The owner's equity is the value of assets that belong to the owners. More specifically, it's the amount left once assets are liquidated and liabilities get paid off. So let's check out what causes increases and decreases in the owner's equity. Increases in owner's equity. Two main sources cause an increase in owner's equity is investments by the owner and revenue. Investments are the cash the owner personally puts into their business. These investments are recorded under a category called the owner's capital. Revenues, on the other hand, represent profit made from business activities such as sales, fees, renting a property, lending cash, commissions, and more. Decreases in owner's equity. Decreases in equity happen from drawings and expenses. Drawings are the cash the owner withdraws from the business accounts, while expenses are the cost that comes from consumed assets. For example, purchase or equipment, wages expenses, utility expense, taxes, and so on. Extended version of the accounting equation. Now, there's an extended version of the accounting equation that includes all of the elements described in the section that compress the owner's equity. So here's what it looks like. This formulation gives you a full visual representation of the relationship between the business main accounts. This isn't the only type of rearrangement you can make to the accounting equation though. It can be transformed and interpreted into two other forms. First is owner's equity, assets dash liabilities. At first glance, you probably don't see a big difference from the basic accounting equation. However, when the owner's equity is shifted on the left side, the equation takes on a different meaning. It's telling us that creditors have priority over owners in terms of satisfying their demands, while the basic accounting equation's main goal is to show the financial position of the business.
Hello everyone, my name is Orphinitis Jr. from Group 2 Report. Here's my report. What is the double entry bookkeeping method? Every business transaction has a double effect on the accounting equation. For instance, if an asset increases, there is always one corresponding. Decreases in another asset, increases in liability, or increases in owner's equity. Now, this changes is the accounting equation get recorded into the business financial books through double entry bookkeeping. Double entry bookkeeping is a system of record transactions and their effects into the journal entries by debiting one account and crediting another. Debits are cash flows into the business while credits are cash flowing out. For every debit entry, there has to be an equal credit entry, so debits and credits should always balance in the end. To understand which accounts is debited or created when money changes, we've made a cheat sheet so you can easily understand. Don't want to worry about doing double entry bookkeeping for your small business? Use accounting software like Disquera to automate business bookkeeping process. Disquera integrates directly with your bank account and automatically posts every and expenses made into the correct ledger accounts with the corresponding debit and credit amounts. The way you don't have to worry about a thing. Disquera About is a time-saving strategy for manager work contacts, invoicing, bills, and expenses. You can also import opening balances and set up charge accounts through it. Disquera Books is the online accounting software that enables you to integrate in invoice of compliance. It lets you easily create an invoices and clicking and generate the invoice button. Now that you have Disquera, you can easily manage your journals. A single interface gives you access to all remarkable features, including the ability to add products, services, and inventory. You can automatically generate and send invoices using this account software. Further, creating financial statements has become considerably easier thanks to the software, which lets you draft balance sheets, income statements, profits and loss statements, and cash flow statements. From setting your organization to inviting your college and accountant, you have achieved all this with the Skera books. You can witness the easy implementation of the tool and try it out to get a renewed experience while handling your account system. Acquaint yourself with a new age system that takes care of accounting, finance, inventory, and much more. Also, a single roof. The balance sheet. The balance sheet is a more detailed reflection on accounting equation. It records the asset, liabilities, and owner's equity of business in specific time. Just like accounting equation, it shows a total assets equal to abilities and owner's equity. Creating the balance sheet statement is the one of the last step in accounting cycle, and it is done after double entry bookkeeping. What are the limitations of the accounting equation? As helpful as the accounting equation, it is doing accounting for your business. It has its own limitation. For starters, it doesn't provide inventors or other interested third parties with an analysis of how well the business is operating. Additionally, it doesn't completely prevent accounting errors from being made. Even with the balance sheet balances itself out, there is still possibility an error that doesn't involve the accounting equation. Case takeaways. To recap, here are some main points we've covered. The accounting equation is the fundamental tool that enables double entry bookkeeping for all businesses, no matter what size or purpose. It represents the relationship between three main entities: assets, liabilities, and owner's equity. Assets are the business resources of such as cash, inventories, buildings. Liabilities are obligations to creditors such as invoice, loans, taxes. The owner's equity represents assets belonging to the owner or shareholders. The accounting equation can be rearranged into three different ways. Asset equals liabilities plus owner's capital minus owner's drawings plus reviews minus expenses. Owner's equity equals assets minus liability. Net worth equals assets minus liability. Changes the accounting equation get recorded through double entry bookkeeping. The balance sheet is a financial statement which represents the accounting equation in its more detailed and expanded manner. The main limitation of accounting equation is that it doesn't provide analysis of how well the business is operating. And that's all my report. Thank you.
First is asset accounts. Are the physical or non-physical type of property that add value to your business. So meaning it is your assets that can become your collateral in terms of any problem in your business. You can sell it and have your money to pay your credit or anyone that you can buy to gain more capital in your business. For example, your computer business, car, and trademark are considered assets. Some examples of assets include checking, petty cash, inventory, and accounts receivable. Next is expenses. Expenses are costs your business incurs during operations. It means this is the amount that goes to any bills or money that you render to any monthly responsibilities like water bill, electricity bill, internet, or when you pay something that it can help to improve your business like when you buy a furniture for your business or anything that you can help to improve your business. It is considered as your expenses. For example, office supplies are considered expenses. Another examples are payroll, insurance, rent, equipment, and cost of goods sold.
Hi, I'm Gloria and Conti, and I assigned to discuss about the equity and the revenue accounts. Equity account. Equity is the difference between your assets and liabilities. It shows you how much your business is worth. So equity is asset minus liabilities. There are three examples of equity accounts. First is owner equity. Owner equity defined as the amount of money invested by the owner in the business minus any money taken out by the owner of the business. The second example is common stock. Common stock is a type of stock issued to the majority of shareholders in a company. In other words, it's a way to divide up the ownership of a company. The last example is retained earnings. Retained earnings referred to as that part of earnings or profit that is not distributed to the shareholders as dividends. Equity accounts increase through credits and decrease through debits. When your assets increase, your equity increase. When your liabilities increase, your equity decrease. Revenue accounts. Revenue or income is money your business earns. Your income accounts track incoming money, both from operation and non-operations. From the word revenue is kita from a normal operation. Examples of revenue accounts. First is product sales. Product sales is an act of selling a product or service in return of money or service. Second is earned interest. It is a rate at which an investment earns value on top of principal. The third example is miscellaneous income. Miscellaneous income are part of indirect incomes. Therefore, these incomes are shown in income side of profit and loss account. To increase revenue accounts, credit the corresponding sub-accounts. Decrease revenue accounts with a debit.
Hi, good morning everyone. We are the last reporter of the group 2 with my partner Miss Cherry Grace Gomez. Our topic is all about the books of accounts. So, the book of accounts is a book where you record all the financial transactions of the business. Entries in the books of accounts are required to the business or to be supported with documents such as official receipts, sales, invoice, vouchers, and other related supporting documents evidencing the business transactions occur. So, tanang business establishment, tanang tax, mga tax or taxpayers are nag-required dito siya to keep the record of their day-to-day operations or transactions in order to know the results of their operations. And then, there are types of books of accounts. First, we have the manual books of accounts, which is the traditional journal, ledger, and columnar book. Recording in the manual books of accounts, handwritten. Account is handwritten. This is typically used by the small enterprises. And then we have there the loose leaf books of account. It is printed and bounded journals and ledgers. Recording in loose leaf book of account can be done using Microsoft Excel. And then there we have the last one, the computerized books of amount. It is an according program that facilitates efficient and fast recording keeping. And then we have the list of books of accounts that a business must maintain. We have there the general journal. This is referring as the book of original entry. It records the transactions of the business in order to date using principle of debit or an credit. And then we have the general ledger. General ledger refers as the book of financial entry, and it summarizes all the journal entries of account to get the ending balance. For the continuation of our report, let's give to Miss Cherry Grace to introduce her topic report.
The continuation of a topic is all about the books of accounts. Cash Receipt Journal. It is a special journal used to record cash sales and or collection of receivables. Cash Disbursement Journal. It is a special journal used to record cash payments of expenses and payables. Sales journal. It is a journal used to record sales on credit. Business engaged in sales of service must maintain the following book of accounts. We have general journal, general ledger, cash receipt journal, cash disbursement journal, sales journal, and purchase journal. That's all. Thank you.